Hello, hello. Welcome to This Month in Real Estate Investing. This is our second episode, and we're super excited to have some awesome guests. Today, we've got quite a few different news items to go over, and top three I picked out to share with you, get you excited. First one, can you actually make money investing $100 in real estate? I tried it, and here's what happened. That's going to be a fun one to get into. Then the housing affordability crisis is sparking startup founders, Wall Streeters, and nonprofit leaders to offer new solutions. And then the third one, mom and pop real estate investors are pulling way back. Here's where and why it matters. So we'll get into our teaser video here, and I'll introduce our guests. All right, we're back. So we've got Alina Herman, Dave Foster, and Matt Cavanaugh with us this month.
You guys.
I'm going to have each of you guys just do a short intro about yourselves, and we'll just start in that order. Alina, Dave, and Matt.
Sounds good. Well, my name is Alina Herman. I've been in real estate investing, brokerage, and even real estate technology for quite a few years. I think we started our real estate investing all the way in 2003. So this is, we've been through some interesting roller coasters through real estate, done brokerage. Currently, I am into technology for real estate, doing some automation, marketing automation for hybrid real estate investors and mortgage brokers and real estate agents. I have also done all sorts of interesting things like human performance, and I'm NLP master practitioner. I want to talk a lot about investing and psychology of it. We will touch base on this as we're going to go through some of the news today. So that's a high level.
Yeah, mindset's important. So I'm glad we're going to talk about that. All right, Dave.
Awesome. I'm going to avail myself of Alina's counsel later because I am a serial real estate junkie, and I've got more than a little case of attention deficit disorder. Over about the last 25 years, I've tried to invest in every type of real estate that happened to come across my path. And early on, in my first deal ever, I felt really good about my investment, which I bought a duplex in Denver. We all know what can happen in Denver. I sold it, and I thought I was king of the hill till my accountant told me what I was going to have to pay in tax. And at that moment in 1996, I realized that every investor in real estate has a silent partner, and his name is Uncle Sam. And the key is how much you can make, but also how much you can keep Uncle Sam from taking. So using my accounting background, I found a way called the 1031 tax-deferred real estate exchange. And now for the last 23 years, I've been using that for myself and for my clients. It's been a fun ride.
Well, that's fantastic. Yeah, a lot of newer investors don't know what a 1031 is, but they need to and utilize that. It can be super powerful. Matt.
All right.
Welcome.
James, thank you for having me on. I'm so stoked to be with you guys. Alina, you're talking about psychology, which is a huge passion of mine. Dave, investing, so our podcast, which James was on a few months ago, is all about helping people become financially free and ideally doing that in a single transaction. And so we're all about simplifying the process. So you can create scale if you want, but our advice is just pick a deal that can retire you all in one deal. And so just super excited to dive in with you guys and provide value. So thanks for having me on.
Fantastic. All right, let's jump into the news. Our first one is, can you actually make money investing $100 in real estate? I tried it and here's what happened. So this is this is interesting. There's a lot of different platforms out there for fractional investing, where you can put in a small amount. Because normally, like apartment syndications, for example, you have to put in 20 grand, 50 grand to get into a deal. So that's not attainable for a lot of the population. So there's these different platforms, and this author did a bunch of work where he took $100 and he put it into 3 different platforms. Ground Floor is one, Arrived Homes, and Fundrise. Fundrise it's been around quite a while. In fact, a friend of mine, he mentioned it to me. He's invested in it. So I'm just gonna take a little bit of time here and just kind of go into his experience with the 3 different ones, and we can chat about it. So Ground Floor, it's got a $10 minimum, which is crazy low. It's a little different than the others. It's basically a short-term private money loan backed by properties, but it's like a hard money loan. So if anybody's familiar with fix and flipping, a lot of flippers will borrow money at a really high rate and purchase the property. Sometimes they use that money for the actual fix and flip process. And so that's kind of what Ground Floor is. So what he did with this platform is he spread out his $100 over 6 different loans. So they've got options. After a year, he's been repaid on $70 of that and made $6.26 on that. The other $30 was a 12% return. That's what he was expecting. It was a little higher risk one, higher return. But that one's on hold right now. That I think it was with a specific property, and the fix and flipper couldn't find a buyer right off the bat. So they've got a new one. So he's just kind of waiting for that to hopefully close and get his money back and make an overall return of 9.96% for his $100. Not bad. And then Arrived Homes, he did that one. That's a first Regulation A platform selling shares for individual properties. With that one, they handle all the property management. These are more like buy and holds. They handle property management, and the investor just collects dividends. So, and then they hope for appreciation during the hold period. And he says currently his return is 25.4% based on appreciated price. And then he got a $3.90 dividend. Now, I don't know how they calculate the appreciation. Maybe they're getting an appraisal. I don't see how they could, come up with a number until the very end, until they sell it. So, and then Fundrise, like I said, that's been around the longest. They invest in large, diverse portfolios. Each fund has a different strategy and objective, so you can kind of pick and choose what you want to get into. Only one of the new funds allowed the $100 minimum. Some of these other more established funds had a higher amount. But after a year, he's got $111.67. So that's not bad either. So anyway, anybody want to jump in with comments on that?
Sure. I can see that Antonio's asking, are these investing opportunities good for the industry? So one of the things that I think is interesting when I read through that article was the difference between some of them are investing in the notes and some of them are investing in the properties. And so that's the first that I was aware. I knew about, Fundrise and these, and you get ownership in the property, but I think it was Ground Floor that invests in the notes. That was a very fascinating thing that just kind of caused me to think differently. I think it can be really, really positive. Even for someone that's getting into investing, just to get to experience those returns and that information ahead of maybe forging their own path. I think it's a way that investors that may not go into real estate can actually break in and then choose if they want to take on the headaches of real estate.
Yeah, exactly. Yeah, because it can be totally different, whether it's a very passive thing or an active, like most of us have experience in or have steered away from, once we got into it.
Well, so here's what I thought when I kind of started looking into that. I think that it might be a good for overall portfolio allocation. Let's say you have capital and you always want to, allocate it into a different bucket, so to speak, and maybe put portion of it in there. Or you're new and you don't really have money to invest into, private loans, which is notes. If somebody's not aware, we actually do private loans for rehabbers, fix and flips. And I find it to be fairly easy investment. But again, it works mostly if you have some capital. If you don't, this is very good investment. I feel like as in real estate has such a hype, I think it's mostly because you get depreciation if you to buy and hold your real estate yourself. In this case, yes, you have a return, but again, you don't really get to use that depreciation in this case. And another thing I always say, if you do not control an investment yourself, meaning you don't control expenses, you don't control where and how it goes, you kind of like buying a stock in a way. It's no different than buying REITs or no different than buying some other company that is in real estate sector, because you do not control expense and you do not control how the money is invested, right? You have somebody else controlling that. And in my opinion, it's always a higher risk when you do not have control over how it's invested, the rules, and do not have control over expenses. So that's my 5 cents here.
Yeah, those are some good points. The depreciation for sure, the control, which is one of the big advantages of real estate over those stocks or REITs, which we'll talk about. We have got another article we'll talk about REITs, which are real estate investing trusts, for anybody that doesn't know the acronym.
Alina, one thing I'm thinking about too, as you're saying that, how would you, because like I totally agree. I mean, ultimately control can be a really, really good thing, especially if the person has expertise in the field. As a private money lender, you're probably lending sometimes to people that have low experience. So how do you gauge like the low experience levels that people have where they might not get good returns because they're not yet experienced with the lack of control? Like, how would you advise people of when it's maybe better to have somebody with more experience do it versus taking on the control?
Excellent question. So here's what I always tell the people that we're lending money to. I'm telling them that I am their partner in a way that I'm going to evaluate the deal because I've seen the numbers and I know how things are. As I am talking to the rehabber, I know right away where they are going to be tripped, where it's going to be problems, how they're running. I literally can tell if they're going to be running too close, and sometimes they'll just would say no, just because if they're new and they're not listening, they're not taking my advice, because we have a lot of experience, right? We've done fix and flips, we've done lease options, we've done, subject twos. I mean, you name it, we've seen it all. So I know the costs and now how the rehab's done. I know like all the different things that might happen. And if I would see the investor that's not experienced and not listening, right? Because if they take me as a partner and say, hey, yeah, I understand you have experience. Let me follow your lead. Let me, like do what you're telling me to, then we have a great partnership and they will be successful just because I am there every step of the way to help them out. So that's how I mitigate my risk, because I'm mitigating their risk first.
Yeah.
Well, and that really brings up and reemphasizes how important it really is to find the difference between the good operators and the bad. And that's probably, I think, where we need to see this industry play itself out. Because anytime you're going to be able to attract investments that little, there's going to be much less financial oversight from Wall Street, the SEC, and the IRS. And that's kind of got to play itself out. Unfortunately, it typically plays itself out in the form of people who get damaged. Because just like Alina's taking great care with her borrowers to make sure that they're doing things right, not every person offering a fund saying, give me your $100 for investing in personal notes, in private notes, is going to be able to take that same level of care or have that same level of due diligence. Remember, they're in the business of making loans to make money. So the first look is going to be at the return, unfortunately. And I don't know, I'm so old as dirt that I can remember 2008. And you know what the tipping point in that was? Wall Street having to sell off bad mortgages that had been made by new and upstart lenders. And so anytime you get into a situation like that, where there's very little brick and mortar asset to attach to, even $100, although it's not much, is still a risk.
Yep. Antonio, who is our producer in the background, helping orchestrate all of this. This is what Dave is mentioning is similar to people who lost a lot of money in crypto recently. That's a good point.
Yikes.
Yeah.
Yeah. Now, here's the difference, though. Those who lost money in crypto, if crypto comes back and they don't sell, will have lost what? They'll have lost nothing. I have a ton of investors that went through the worst of the worst in 07 to 10. And those that did not have to sell their real estate did not lose a penny. They lost a lot of paper value, but they lost nothing. And now they got more money than Davy Crockett. So if you're investing, and this is Dave's argument for bricks and mortar, if you're investing in whole real estate that you own, maybe it's by yourself, or it's with a partner, or as tenants in common, if it's actual real estate and it doesn't have to be sold, your risk is very low. If you're throwing $100 into a fund and you've got no ownership, you've got no recourse, your money's at risk. And if that industry, if that borrower has to sell, or if they misjudge on that first reno, right, Alina? And they have to incur the dreaded rookie tax so they don't make anything, that's where they get in trouble.
Yeah, and just to kind of shed another perspective on it too, not that I disagree with you guys. I think the value sometimes is in understanding like who is the person that's investing the money. Is it just a brand new investor that has very little, or is it somebody who's seasoned? Is it somebody who has a really, really high income? I know a lot of people in my network that do invest in REITs. And one of the reasons I think it's great for them is because they have the ability to understand what a good operator is and how they operate. They're able to vet operators for track record. And so in those cases, it becomes more valuable for them to get the return without the work because their time is best spent in their W-2 or in their line of work. Whereas like, I like when you guys are saying it's risky, I think for someone, if it's your last $100, like don't do it, like in any case. So I think context can be very valuable too. And, if it's a good strategy or not.
Well, yeah, but isn't that exactly who these are being marketed to? It's
Certainly.
not to the high net worth accredited investors, right? They're trying to get that $100. And Matt, I know what you guys put into in your due diligence. if someone's investing $100, what do you think the odds are that they're really going to get an education? I like the thought that I can start out with $100 if I'm going to learn how to do it myself. But I don't know. What do you think? Are they going to get a lot of that real boots on the ground education?
I don't think they're going to get an education. I think you're spot on with that. So what I'm envisioning too is like, okay, so maybe you have an engineer or a doctor or somebody that has some wealth, some income that literally just wants to splash in, doesn't quite have the time, but they're not like you and I, they're not in the field practicing. And so for them, they're not throwing obviously $100 in, they're probably throwing in 5,000 or 100,000 or something like that. And so, and I agree with you. This is the reason the minimums are 100 is because they want the everyday person to invest. But I would say the play is not necessarily for learning because you're not going to get it. It's really for like exposure and maybe overcoming some limiting beliefs that real estate is a field where you can make money. The ultimate way for most people to make lots of money is to do the thing. But I mean, it's hard. It takes a lot. Like someone has to be dedicated to the path. I mean, to be a rehabber, I mean, you have to learn how to comp, you have to learn how to find properties, and do those processes. That could be pretty daunting.
Yeah, and the same with like multifamily syndications. A lot of the general partners lead with education, and then a lot of times the people that thought, "Oh, I'm gonna quit my W-2 job and go do this," realize there's a lot to this. I need a team. I'll just do my W-2 job. That's what I know. I'll just invest my money in with this group that they have learned and gotten to know through the education component, and then they put their money in. So, yeah.
I think last things I wanted to mention about investing in the asset like this, there's also a benefit of having leverage, right? Real estate is probably one of the few where you can have a leverage and collateralize it by your real estate and kind of get your returns higher. In private lending, you can also collateralize your notes, and I know I may be speaking a little bit jargon for somebody that's new, but those where you can literally start getting infinite returns. Now we're having returns maybe 5-10%. Now when you are carefully using leverage, smart leverage that's calculated, then your returns can really be much higher than you can get here, and you have more control again. So I would suggest as the bottom line, this should only be as a fraction of your overall portfolio to diversify. By no means it should be an all be all an investment. And also, if you have a 5 or 1,000 to invest only, I'd say invest in your education, hire a mentor, get some training. I think that's where you're going to get highest return on your investment. And that's where I started in real estate. We spend hundreds of thousands of dollars on different mentors, educational programs, you name it. So I feel that's something that is probably be more valued if you have $100, buy yourself a course. Don't do this. Just do this as your, overall portfolio diversification. That's my advice.
I think it's a really interesting option to do as in conjunction with your regular stock investing, because it's just another niche. I kind of like that. It's like, yeah, I'll go to Apple, I'll invest in a Walmart dividend stock, and I'll throw a little bit here. And that can be kind of a nice conjunction. Alina, I think I like your take on taking money and using it differently because it's a longer path by putting it into education. I think that's a really solid point. I want to offer another option, and then maybe Matt and James, let's hear what you guys say about this. If you've got $5,000, the best way you can learn to become a real estate investor is take that $5,000 and buy your first primary residence. And just go and buy what you can afford using the advantaged FHA financing that's favorable to you. And 2 or 3 years later, after living in it, making the mortgage payments, learning how to fix toilets and sinks, and also putting more of your own money into it, the profit is going to be tax-free. Now, that's where Dave lives, is in the tax-free environment. But if all you ever do in your life is buy the house you live in it for at least 2 years, and then sell it, the profits are going to be tax-free. That's a pretty enticing thing. I think that's going to lead into what we're going to talk about in some of our other articles. But I'll throw that out as another option. Investing in education, investing in your first real estate, which is something you live in. So you've got a vested interest, and it's right there under your nose, keeping you active building it.
Great point.
Right there with you.
100%. And maybe just to throw a little bit of spin on it too. Like, I love the fact that you're both saying education. Education is the foundation. And if you are the person that wants to become real estate knowledgeable and go into that field, there's nothing better. There are so much information out there via this show, via other shows, I believe now that there's enough free information out there that you can become wildly wealthy without spending a dollar. So while I'm not discouraging you from spending dollars on coaching programs, because that's where education information gets organized and can be, beneficial, you can, if you're able to take maybe a combination of Alina and Dave's concepts, get educated, like what Alina's saying, take the money and get active. Like, if you're the person that wants to be in the field, take crazy action. House hacking is a phenomenal idea. And then Alina mentioned some other strategies too, which are really good. The creative strategies where you can buy with zero money. And so that's another thing to consider.
Yeah. Or what about this? What about, instead of investing in the coaching events, which tend to be pretty hyped up, go invest in the books that the coaches have written.
100%.
Spend a few dollars, go buy a coffee, read a book.
Yeah.
Yep.
And then start talking to people like Matt and Alina.
Yeah. I got my start with Bigger Pockets, based here in
Bigger
Denver.
Pockets.
Tons of information, not all of it good, but it's a good place to start and start getting your head around, like, which asset class and strategy do I want to go down? And then at some point, it probably would make sense to get a coach like I did. I picked something, paid that money. It stung. It was 18 grand, but the amount of money I have and can make based on that is way more than the 6 or 9% that, like, this guy was making on his $100. So, well, I think we should probably jump into the next article, unless somebody's got something about this last one that they want to say. All right. Let's see. Think the housing market is bad? CRE prices are dropping by double digits, and they're not done yet. So we're talking CRE, commercial real estate. So it's in this article, they talk about how commercial real estate dropped nearly 13% from the peak earlier in 2022. They didn't say what month, but and then it's down 7.3% in October alone, according to Green Street, which tracks a lot of this data. Apartments, offices, strip malls, healthcare related properties have all experienced double-digit dips. Facilities, housing, hospitality, and self-storage businesses fared slightly better and are down only 6%. Interest rates, they talked about, may rise in December, according to Forbes. So that's big on everybody's minds and really has a big effect on this. But investors, smart investors that have been, especially ones like Dave, you were saying, you've been through the 2008 downturn. You've seen what happened there. And so a lot of investors understand that there's a lot of opportunity coming with a down economy. So,
yeah, I spent most of 2008 laying on the ground in a fetal position. That was how it was, man. But when I read that article, I would have changed the title. And it's all in how you look at it. I would have changed the title to "Think commercial real estate prices are attractive? Just wait. They're going to get better." It all depends on who you are, right? If you're the seller, yeah, you're not having so much fun. But I can't wait for commercial real estate prices to drop another 15%, because that is opportunity to buy. And it's really interesting. That's exactly how the entire commercial real estate industry is calculated. It's all based on a thing called cap rate, which ignores the cost of financing and simply is a ratio between your net operating income and the value of the asset. And the best thing that you can do is to buy a property at as high a cap rate as you can. Maybe it's $1 million property and you're making $100,000. Now, remember, this is irrespective of financing. If you're making $100,000, that's a 10% cap rate. You'd love to buy it at that and then sell it later for $2 million when it's still making $100,000, because that's now a 5% cap rate. And that's what we've seen over time, is that cap rates and prices of commercial real estate have risen, but income, not so much. And of course, the big joker of COVID and all the aftermath of that, oh my gosh, what that's done to office, those guys are going to be in therapy forever.
Yeah, right.
But that whole thing, we're going to start to see opportunities where you can then buy and let your lease increases and let the natural appreciation as it turns back around start to create a favorable situation for you. Real estate is nothing more than a cycle. It comes and it goes, and it doesn't matter where you're at in the cycle, there's a way to make money. What matters is that you know where you're at in the cycle and act appropriately.
Yeah, that's a good point.
I love what you're saying, Dave. And one of the things I love the most is that you differentiate between perspective. Are you the buyer of that asset? Are you the seller of that asset? When prices are coming down, somebody is very happy and winning. When prices are going up, so there's always winners and losers. And what I would submit too is that winners and losers when it comes to price only happens if you're playing the speculation game. So Dave, you talk a lot about being in a tax shelter through 1031 exchanges, which were phenomenal tools. But if you switch mindset from playing a finite game where you buy and sell properties, frequently versus playing an infinite game where you plan to hold these your whole life, then market cycle seems to matter like almost nothing. Like if you look at any property today, compare it to what its price was 30 years ago, you got the deal of the century. And so I think if somebody is scared to get into real estate because of where the market cycle is at, they just have to ask themselves, are they playing a finite game or an infinite game? And likely they're playing a finite game. And I would encourage people to think along the lines of playing an infinite game. When you look at the asset and you're looking at the cap rates, am I okay holding this asset for 50 years and generating income for 50 years? Because then the price you buy it at becomes just about irrelevant.
That's so true.
Absolutely right. And this really dovetails into what Alina said when she talked about responsibly using leverage, because leverage is the joker in the deck. Leverage is what forces you to sell a property when you can no longer rent it for an amount that will cover your mortgage and bring a return. It's what will force you to sell an asset when it's a 5-year adjustable mortgage and it resets. And if you have to, with what you're saying, if you have to sell at a certain point in the cycle, like 2008, you're dead. But if you don't have to sell, if you can simply hold and play that long game like you're talking about, then you don't care where you are in the cycle. Now, what I see people doing, and Matt, I'll bet you got some folks that are doing this a lot, is that they will use the inside the cycle to identify where they are and then use that to move their portfolio. 2010 to 2015, what was happening in California and Seattle? Oh my gosh, it was insane. Prices rising. Well, what's the cash flow like in Seattle, Washington right now for rental property? I think there's an industry term. It sucks. So, and a couple of the articles that we looked at talked about places where there's price retreats happening most often. Seattle is right at the top of the list. So, but people will use the 1031 exchange to calculate. Seattle has topped out appreciation wise, but I could go to Omaha, Nebraska or Tampa, Florida, and I can buy cheaper properties, or I can buy better cash flowing properties, and I can move into something where I'm still going to spend the same amount of money, but I'm going to vastly increase my NOI because I bought into a different sector. And that's what I like about using the inside the cycle thinking to adjust your portfolio periodically, whether it's into a different type. We're just now about to hit a sweet spot for investing in commercial properties coming up when they start to drop again. So move from residential to commercial. And those are the kinds of things that you can do that we help our folks do in the 1031.
Yeah, this is so valuable. Like what you're saying is so, so valuable. Like I like to call it like the rain cycle effect. Like you have an evaporation cycle. When you look at states like New York, California, Washington, et cetera, these are all appreciation states. And then you look at the Midwest where you have deep cash flow for low prices. And you look at the fact that when the market crashes in California, it crashes big time, 50%, 70% sometimes, like in 2008. And then you look at the Midwest, like there are places that they might have dropped $2,000 on a property. And so if somebody's wanting to maximize their wealth and they're willing to use 1031 exchanges and some of the tools you talked about, Dave, they can transfer their portfolio into assets that don't drop in times of trouble, wait it out, and then 1031 exchange or refinance out and buy when those appreciation markets are at their bottom or at least are on the low end. So that is a massive way to grow your wealth tax-free and collect. And the cool thing is once you know the market cycle is high, if you transfer your wealth into cash flow area, your likelihood of getting into trouble is a lot lower because you have so much cash flow that covers the asset. So I love what you're saying.
Yeah.
Yeah. I actually I agree with you guys. Awesome points. I wanted just to add something specifically for commercial real estate. Traditionally, commercial real estate is very highly leveraged, right? Those are, probably millions of dollars properties. You always need to use leverage to do it. And it is an asset that is highly sensitive to interest rates. And the way, and David, just kind of like to add to your capitalization rate point, financing where it plays in. Let's say you have 100,000 property and you'd get 10%, return, which is your 10% cap rate. Now that 10% cap rate decides how much leverage, what interest rate you can afford for that property. If you let's say, take a 5% loan on the property, you get 5% on top of your leverage. So essentially you're making a spread between your cap rate and your leverage, which is giving you a 5% return on your leverage. That said, you getting your 10% return, your cash on cash, which is your down payment, and then you have 5% return on your leverage, which overall can be really good returns. However, in the times when the leverage or your interest rates go up, let's say we are actually in the Midwest markets, but it would apply to any market overall. If you have 7, 8, 9, sometimes percent, if those are high risk investments, and your cap rates haven't really changed in the market that much, then you essentially have almost no return on the leverage. That is the period of time when typical deleveraging of the assets occur, and therefore people have to sell, and that brings property values down. Again, as we mentioned, real estate is a mind game more than it is in a finance. Of course, you have to know your math. In any market, there is just a different strategy that you can use, understanding how cycles work, and not only cycles, but even more your hyper local markets, because markets are super different, right? And there's high volatility markets and there's low volatility markets like our Chicago area where we at. So that's just a couple of points I wanted to throw in there for you guys.
Yeah, that's good. Antonio also mentioned that there's going to be tens of thousands of layoffs in the tech industry, and that's going to have an effect on commercial real estate. And we'll get into the occupancy and kind of other shifts in commercial real estate, things that people are doing to convert office spaces into, places to live, things like that.
Storage.
So self-storage, yeah. There's a lot of people thinking about what's next. So if
I'm
anybody,
trying to figure out what it says about us when we can lose thousands of jobs, but we don't throw away any of our junk. We pay to store it. Help me with that.
yeah,
The four Ds, right? So the self-storage syndicators that I talk to, it's funny. I mean, they talk about death, dislocation, divorce. You know, all of these things happen in unfortunate market cycles because of the stress and so on and so forth. So it's a function of movement that happens in these difficult times. It's crazy.
it reminds me. A friend of mine was engaged to a gal that's she's from Spain, I believe, and he mentioned something about self-storage, and she's like, "What do you mean?" She didn't even know the concept. She's like, "Why would you have more stuff than you
can fit
have
your
a place
house.
to store?"
Yeah.
it just doesn't even compute for
put
her.
it on sale next month again. Don't worry.
Yeah.
Well, I sold my house in 2019 and put stuff in storage thinking, oh, it's just going to be a month or so. Well, it's years now, and I've been paying a couple $100 a month for it. I'm like, why don't I just go sell all that crap? Like, keep the, family heirloom kind of stuff, but like, why am I storing a mattress, that's taking up all that space?
Right on.
Dumb. Anyway, well, let's jump into the next article. Do we need to take a break, Antonio?
No.
Nope. Okay, we'll do one more here. And okay, title is Real Estate Agents Aren't Surprised Digital Brokers Like Redfin Are in Trouble. This is another good one, a juicy one. So last month we talked a lot about Open Door fire sailing homes that they overpaid for, especially the Phoenix market. And there was examples of paying 700 something, and they dropped the price to like 590 and still haven't sold. So in this article, Zillow, they talked about Zillow discontinuing their iBuyer program. Redfin did the same thing last week, or a couple weeks ago. I didn't even know what it was called, but yeah, it's Redfin Now was their division. And it's eliminating its flipping business and laying off 13% of their staff. So agents are saying, I told you so. Yeah, and I'm a licensed agent, so I've been saying that too. Not to be a jerk, but we were looking at that industry going, things aren't computing. Like, how are they paying this much? And there's a lot to dive into here.
Well, I'll pile on with you right there, James. For years, Zillow has been my emotional support animal. Anytime I felt bad about myself and the real estate that I owned, I just went and used Zillow's estimates. And I felt so much better. I was so much wealthier. Yeah, it made no sense. It was a tech company that saw a way to get into real estate, and whoever was pulling the dials didn't know how to evaluate. And voila, this is what happens.
Yeah.
I'll tell you guys a great story. Literally 12 months ago, last December, I bought a house from Open Door in Tamarack, Florida. I bought the house after Open Door outbid me for it. They bought it for $10,000 more than I was offering. They turned around, they put it back on the market because that's their business model. And I ended up buying it for $10,000 less than what I offered because whoever they had managing it had missed a couple inspection items that made it unlendable. And we had to turn that around. That kind of stuff is out there. If you're not on the ground and if you're not really versed in valuation, there's a reason why appraisers go to school. And data by itself doesn't. What's the old saying from accounting school? Liars figure and figures lie. Figures can be made to say anything. And that's what these guys are becoming victims of right here.
Yeah. In the article, one agent said the issue is that they take the data that we as agents pay for and then try and sell it back to us. And obviously now we're seeing that their data is
Yeah.
not that good either, but they're definitely selling leads, which kind of another point with these guys is that they became brokerages and started competing against the agents that were giving them ad dollars and supporting their business. And then all of a sudden they're undercutting them by offering like 1-2% listings. So there's a reason agents do not like those companies.
Hey, Alina and Matt, do you guys have a property management component to your businesses?
We don't.
Because I'm curious, the one place where I see Zillow knocking it out of the park right now is in their rental ad business by creating a portal for landlords to advertise rental listings. And I know, James, that's kind of bypassing the realtor, but in the past, I mean, up until the last 7 or 8 years, it was always print advertising and media advertising and that kind of thing where people went to rent properties. And that kind of went away. And it seems like there's been a transition to the realtors becoming more involved. And I loved it when I saw Zillow start to pick up this up because I thought that's another avenue. There's got to be some place where renters can go consistently to find a comprehensive stock of rental properties. And that may be the niche that they can all get into. I don't know.
Yeah.
We traditionally avoid rental market because there's not enough commission in that, essentially. Right. And it's a little tougher crowd, I guess.
Crotchety investors.
Yeah, so it's not exactly the lucrative niche in a way. I'm still trying to figure out how Zillow would be making money on it. I think they're offering a monthly rent collection for maybe certain fee. I think that's where they're going with that, and probably with a large volume they can do that. I think that there is something in it. I just don't think that that's for an average investor. It's probably not exactly applicable, but yeah.
I can offer a maybe unique perspective. I know a lot of agents were not happy with these companies. I personally have a lot of joy that these companies exist and a lot of benefit. And so maybe this perspective might give some people ways of making additional money. I have actually made multiple six figures, if not more than that, because of these companies. So first and foremost, they're data companies. And so one of the things they do is they publish all the data. Our teams work expired deals and things like that, and for sale by owners, so on and so forth. And so they've provided essentially free leads to us for the last 5 or 10 years. And so we're very, very thankful for that. But we're also very thankful, and this is something that if for those of you that are building landing pages and tech and things that are aiding your business, they built out these multi-million-dollar funnels and processes and R&D and testing. And so given that tech is so accessible to us now, we were able to learn a lot from their spend and get more profitable funnels much quicker. So I would say I'm very, very thankful as an agent that these companies exist, because they significantly help me make money without spending as much.
Yeah, I know a lot of people.
I'm right there with you, Matt, because we were always studying. We are in technology. We're building funnels. Essentially, we have a whole platform of automating the funnels, automating the content, the pages, and we are always looking at kind of that as a baseline when we're doing our A/B testing. Because why reinvent the wheel? You can just take that and essentially start from there.
100%.
Right,
it's like I feel like Zillow is like our sugar daddy, So I have nothing but good things to say. And on the consumer side, I'd love to get your guys' take on this. The one thing I've been thinking is these guys have been overpaying for houses for a long time. Obviously we knew it was going to crash, but one of the things that I was thinking is this is good for consumers. They're getting more for their house. Consumers are getting more for their house. Agents, if they leverage it right, are winning. The only person that's going to lose is unfortunately these companies. So I've been kind of sitting back and just enjoying the ride.
Good way to put it.
I just realized that I wasn't seeing the comments from other viewers. So one of them from a Facebook user says, also, raise rental application scam awareness. I'm not super familiar with what people are pulling.
Oh,
You
we have
guys have any
tons of that
comments on-
here. Oh my goodness. So what will happen is you put a house on the market, and then literally these people in these other countries, what they do is they go in and they post that house that's for sale, that's vacant. They verify that it's vacant in the MLS, and they put it for rent. And then people, what they'll do is they'll pay the deposit to these people via, whatever the wire transfer companies are. And then they'll show up ready to take occupancy of these properties, but these people live in other countries.
Yeah, it's crazy. Another comment: false landlords advertising rentals and cashing in on rental applications. Okay, yeah, please.
Yeah, and they rent them for like half. So like, let's say market rents are 2,000. They put them on the market to rent for 1,000. So everybody and their mothers is wanting the deal. So.
Yep, if looks too good to be true, probably is, right?
Yep.
Scams in real estate always were and always will be. It is kind of one of those things you just have to be aware of, especially if you're renting something. You would imagine you have to take a look and meet the person that's going to be your landlord, because your landlord can make your life pretty miserable if you're not really in touch with the person and kind of had a little bit of a connection. I don't know if I'd be personally renting, but I've been out of rental market personally. I haven't rented in many, many years, in decades. So I don't know if I'm necessarily the right person to speak on that.
Or the other direction, for a landlord, they usually want. I'm recalling a statistic, I can't remember what it was, but the single most telling fact of what kind of a job applicant you were interviewing, you could find out by walking them to their car and looking in their car. Yep. Is the car a mess? Is it immaculate? Et cetera, et cetera, et cetera. The reason for landlords to meet their tenants, look in their car.
Yeah. And I've heard other people say, yeah, go meet them at their house that they're renting to sign papers, and then you're seeing how they live in their house. Because some people's cars may be different, but you're right, it is a good indication how their house is going to be.
Good ideas.
Yeah. All right. Antonio, what's next?
He's checking out Zillow for a house to buy.
Yeah.
Dave, what market are you in?
I'm sorry, what was that?
Are you did you say you're in the Colorado market?
Well, I live in St. Petersburg, Florida. We invest nationwide.
Awesome.
So right now I'm in the Rocky Mountains and Kansas and Florida.
Love it.
Cool. Well, let's take a quick ad break, and we'll get back into it after that. So, are you ready to ignite your financial freedom with what has been called the hottest REI strategy around, or should I say strategies? Enter Jason Palliser's 2-day investment blueprint, where you will learn the secrets that the real estate investing community doesn't want you to know because they never had a reason to before. Or actually, I read that wrong. Sorry. This is where you will learn the secrets that the real estate investing community doesn't know because they never had a reason to before. A very different way to read that. So with Jason's 2-day investment blueprint, you will learn how to tackle real estate deals with over 40 different strategies, which means your chances of losing another deal nearly disappears completely. In Jason's 2-day life transformation intensive, you will learn how to get more deals, close deals faster, win more deals over other investors, multiply your real estate deal strategies, and much more. Jason Palliser's 2-day investment blueprint can help you grow your REI business to 6 and 7 figures faster with much less aggravation. If you want to learn how to actually invest well in any market in the US, even the tough markets, and close multiple deals per month, visit 2dayblueprint.com. That's the number 2dayblueprint.com. And make sure you tell them you heard it here on This Month in Real Estate Investing. Don't believe the no more good deals hype and visit twodayblueprint.com today. All right. Let's see. Let's jump into the next news item. Let's see. Find this. Okay, the housing affordability crisis is sparking startup founders, Wall Streeters, and nonprofit leaders to try to offer new solutions. Just some data here. Median price is $454,900, which is the highest ever in history. Mortgages top 7%, the highest in 20 years, and median rents are at $2,000 a month, which was the high in May. Obviously, we're starting to see some softening of rents too. So there's a company called Landed, and they talk about it in the article. Landed helps buyers with down payment assistance up to $120,000 to reach 20% down payment. But this is interesting. The buyer agent has to pay Landed part of their commission as a sort of finder's fee. So I thought that was kind of interesting. They also talk about Icon. It's a tiny home manufacturer, and they're using 3D printing to print homes, which is really exciting technology. Let's see. Rent receiving companies are giving rewards for paying rent on time, including boosting credit scores. Not quite sure what they were getting into there, but or really how that's helping people achieve home ownership. Well, definitely the credit scores. You need a good credit score to be able to get a decent loan at a decent rate. But other than that, they're giving like coffee, gift cards and stuff. Which
I thought John Cena and a purple cow could do that too.
Also, they mentioned how Bank of America launched a zero down program, which I'd be interested to see what you guys all think about that, because it just seems like the more there's like a fine line, right, between making homes affordable and being able to get into them, but also not putting somebody in a bad position and getting into the same situation we had with 08, right? So we'll come back to some of my other notes. What do you guys think?
Yeah, the first point you started on with was agents paying part of their commission for this down payment. Was it clear? I don't think it was clear to me from the article whether or not those buyers were already working with the agent or if the buyers came from this lending thing. Because I'd probably feel differently about whether or not I would want to pay my commission depending on if I had procured the buyer or if that company was procuring it.
Yeah, it wasn't clear, and that came up in my head too, because if you're bringing the buyer to them, it shouldn't be having to do that. Although
it's more like a new generation company. That's what kind of like my take on that was. They attract with their lead funnels. Hey, we help you with down payment. They generate leads for real estate agents, and then they sell those leads, with basically on a commission split, and then they get some mortgage company, put in, like even that same Bank of America being on the back end, giving those zero down payment deals. So it's always kind of like they're eating the cake off both sides.
Mm-hmm.
That's a great way to phrase it. Okay, let's face it. Every one of these companies we just started talking about are all for-profit companies, right? They exist to make money. In every real estate deal, there is a finite amount of money. Now, you don't know what that is or what, but there's only going to be so much. So I'm sorry, insert a third party, they're making money somewhere. And they're not just giving their services. Bank of America is not offering zero down payment for your benefit. It ain't happening.
Not charity. That's for sure.
That's true. This kind of brings up another idea back to the original thing about the agents paying. Like, my rent to own company, a lot of deals come from other agents, and these are deals that they can't get qualified. Their buyers can't get qualified, so that's a dead deal for them, right? They're gonna have to call them every 6 months or whatever, and hope that they get qualified. But if we can help them get those buyers into a home, there's some value in that. So we often do a split of the commission, because we're making it happen. And so it's a smart agent realizes, hey, I was getting zero before, but now that we're working together, we're all going to make money and help those buyers, which is the ultimate goal, get into home ownership. So.
And I think, James, that's why your model makes so much sense, because they don't take ownership of the property until they can qualify traditionally for a loan. I mean, I think traditional lending guidelines are there for a very, very good reason. And I know people can benefit from owning homes, sometimes before they're financially ready, but you see what happens when they loosen financial guidelines, more foreclosures happens, and the pain and the challenge of all of that is most people don't want to go through that. So your strategy, I think, is fantastic, because they get to have a lot of the benefits with that option that they've locked in, and yet they're not actually taking on that risk until they're financially proven that they're in a good spot.
Yeah,
it's a great model, James. I did something similar at the granular ground level many times, where I would go shopping with a client who, well, not a 1031 client, but just a client of mine who wanted to get into a property but could not qualify to buy it. And what we did was we bought them and then gave them a lease option. And everything was spelled out, from escalating rents to the strike price when it was done. And what we saw, and I'll bet you see this as well, is that they took so much pride of ownership, even though they were truly just tenants for 2 or 3 years, that those houses were kept immaculately. And as quickly as they could, they got themselves into a position to be able to buy it. That's the kind of bootstrapping that I really applaud. I see that making a difference.
Yeah, totally. And that's the point about them taking care of the property, is that one of the biggest advantages for investors compared to a regular rental, where somebody's just got a small security deposit and they don't have any intention of buying. So they don't care. They may be good people and take care of the property, but there's not much of a guarantee unless they've got some money, some skin in the game, and have that intention of being a homeowner of that particular house. So,
Something that I kind of was on my mind as I was, reading through a lot of those articles. Right now, the prices been pretty high. I mean, all times high, right, on the purchase and the buy. And a lot of us as an investor community, we're kind of waiting, the rates are up and now it's going to be another crash and the price is going down. And now, as I was thinking about it, I just don't see the prices going down in like a stable markets like Chicagoland area, Midwest, too much, primarily because back in the day, like almost 20 years back, the prices of materials were literally half, if not less, than what they are today, right? It still takes money to build those things. It still takes money to, like, land prices went up. So I just don't see material prices going down if you're building the house. So I just feel that affordability will still be a problem for a while. I think our inflation, as much as they're saying 9%, I mean, we all know the way it's calculated, and then that's not 9%. So it is way, way higher for those who want explicit verbiage, I can't quantify how much that exactly, but I am seeing, prices are way higher on things just to build a house, right? So I think that we're going to probably see things in this country as they're common overseas and multiple generations living under one roof. That will become more of a thing, right? The people will not be moving out. People will start realizing maybe multi-generation is not that bad. I grew up in Soviet Union. It was very common to live with your grandparents where they take care of little children. So I just don't think we may go like in overall the entire country won't be switching to that. But I think that the lower income families probably going to be sticking with it for a while longer. So I don't know if you guys, Matt, Dave, what you guys think, where's the market is in that regard.
Yeah, absolutely. I like to follow the giants as far as research, and there's billions, if not trillions of dollars being poured into the co-living space. And so exactly to your point, Alina, is if you're living in a big city or outside of a big city where there's more of an affordability problem than just more rural areas, I think not only are you going to see people living with their grandparents, but you're going to see people living with other people. We actually own some properties that are rented out by the room. And in our research, what we did is we said, okay, what does a studio cost? If we offer a room in a house at 70 or 80% of the rents of the studio, would people want that? And it was overwhelming, because it wasn't just the fact that a comparison between the studio and the price. It was also, hey, this is the best option for low cost. So I think people living together in all different ways is going to become more common.
Are you talking about the shared living concept?
Yep.
As in a shared common space?
Yep.
Yeah, interestingly enough, though, we're kind of seeing rumblings in the college housing markets, where there have been in very recent years tons and tons of these 4-bedroom, 4-bath, each bedroom has a bath, and shared living space models. And they had some initial success, but what we're finding is that appreciation in that model is much less.
100%.
Because it's so purpose-built.
Yep. Yeah, 100% agreed. Yeah, so the owner, if they're building that way or modifying for that purpose, are giving up an appreciation in exchange for more cash flow. And so my just off the cuff prediction there would be, if you're in a non-appreciating market anyways and you're investing for cash flow, it's probably a better play than giving up an appreciation in a market that could appreciate a lot.
Yeah.
Right. The question is what's appreciation going to do? The way I see the market is it's all just a function of money, right? At its most simplest form, inflation is what? Too much money in the economy, and it's not working hard enough. So we're raising interest rates, and interest rates wipe out stock equity, cash. They wipe out paper worth on real estate investments, and that artificially starts to reduce the amount of money, so it reduces inflation. But there's still a lot of cash that's out there chasing. And that's the paradigm we've seen that has never been in past generations. And that is the large funds pursuing single family houses and smaller multis. Instead of going bigger, they're casting a wide net because they see the opportunity to take advantage of that now. That's going to have ramifications for everybody who's the mom and pop and wanting to break in. And that's going to artificially, I think, keep prices up or put pressure on them to stay up.
Yeah, we'll talk about that in that article on mom and pops. Another thing I wanted to point out from this article was the conversions of office buildings. As we know, that's office space is the one sector of commercial that's hurting the worst. So they're converting office space, hotels, churches even, into apartments. And there's even, I don't know if you guys got a chance to read this, but let's see it. Gensler is the biggest design firm in the world. and they've got an algorithm for analyzing commercial properties to see if they're a good fit for a conversion. So they don't have to go in to each property. They can, I guess, just look on CoStar or wherever the stuff's listed and figure it out, maybe get floor plans. So it's interesting how people use technology to do stuff like that.
And I think there's some element of it that's really positive. We obviously were in an affordability crisis because there's not enough housing supply.
Yep.
And given that land is finite, if we're getting a lot of the land back from the businesses because those businesses can be run virtually, I think that's awesome that we're going to be able to convert those into living and give more options to people to live, effectively creating more affordability.
Yeah, I think that's probably one of the biggest things that we can do to help that affordability. And, like Alina, you were talking about construction costs. Like building an entire building is cost prohibitive today, but if you already got the walls and you're just making some adjustments, that's a much
less costs.
Well, that's real estate cycle 101. That after a market crashes, in its early days of rebuilding, it is always cheaper to buy existing structures and renovate. That's why in the residential market, fix and flippers go crazy early in a market. After commercial crashes, you start to see these conversions because it's so much cheaper than building new. And then at some point in time, these two things cross. And then that's where we're at right now, where once again, we've about crossed the circle to where once again, buying existing will become cheaper per square foot than building new. And you just have to follow that and think and vote with your pocketbook, but vote with your head and not your heart. And that's the same thing with developing the new urbanism. I love the thought. I have a 26-year-old son who whips me every day. Dad, we need more urban core housing. Okay, but you can't force people to buy it. So we've got to have a mindset change at the same time that we start to create that product. If you simply build a product without a paradigm change, it'll fail. And if you have all the desire in the world, but nobody's willing to buy it because they're making more money in other places, then they're not going to build it. We got to have a confluence of the two. And that's where I think the federal government, oh my gosh, I can't believe I'm saying this. We're going to have to edit this part of the tape, but this is really where I think the federal government could have a role in incentivizing certain development. Now, the simple fact that we involve the federal government will guarantee its failure, but it's a thought.
So can you dive deeper into that? So like if you can lay out a little bit of like how would you use the federal government to incentivize?
So a mentor once told me to look at the tax code in a whole different way. And it's changed my thinking ever since. He said, don't think about the tax code as a way for the federal government to make money so they can buy roads and hospitals, et cetera, et cetera. Think about the IRS tax code as a behavior incentivizer.
100%.
So just like 1031 exchanges, they want to see 1031 exchanges happen because they would rather not collect capital gains tax on long-term held real estate income. They would much rather collect ordinary income tax from 2 realtors, 2 painters, 2 title companies, 2 appraisers, et cetera, et cetera. The dollars are much more. So what do? They incentivize that by making 1031 part of the tax code. What about FHA lending? Favorable interest rates, favorable qualifying guidelines, all designed to incentivize what? First-time home ownership. So I don't quite know what it looks like. Well, actually, I do too. Although whether it's succeeded or not, we'll see. Opportunity zones.
Yeah, I was just going to
Right, 25% of every state had to be designated an opportunity zone. And then incredible tax benefits for buying in an opportunity zone and building it up. Well, there's an incentivizer. But the problem is, it's like the old proverb, wherever you go, there you are. And if you're buying an opportunity zone and then turn it into beautiful upscale condos, but it's still in the middle of a depressed opportunity zone where nothing else has changed, what do you think the chances are of you being able to generate rents commensurate with the expense that you put into it? But it's those kind of incentives, but they have to work together, which is why, given the way the federal government is right now, it's not likely. But there's got to be some things that can be done to help make it affordable.
Well, and to dive into your point too, like a lot of times, so like I love your incentive analogy. Like it's on point, and at its core, I think like you still have to solve the root problem. I still think like all of this is like a symptom. The root problem is that people are not living up to their potential. They're not becoming educated. They're not, and so these zones exist because you have pockets of people who are not maximizing what they can do. And so ultimately, I think the solution that's like more holistic is like we have to like, help people create change in their own lives. So these zones are actually built up by those people. It's the difficult, if not impossible problem, but it's probably the only thing that actually solves it.
Sounds a lot like a free market to me.
Yeah. I wanted to bring up something else that was in the article that was interesting. In Cincinnati, a local organization spent $14.5 million on 194 single-family homes in hopes of keeping them out of the hands of investors, assuming they bought some affordable pre-existing homes, not built to rent.
How much did they pay?
$14.5 million on 194 single-family homes.
Holy cow.
When I read that, like my first thought was, wow, this reminds me Soviet Union. That's what Soviet Union did. They would own all the housing and they would provide it to people. I was like, are we moving in the right direction?
Yeah. Well,
I mean, I understand where they're coming from, all that's paved with good intentions, I guess. But I think housing should be somewhat incentivized by the government with some, certain tax codes, right? And maybe grants. But I don't think that government should be in any way, shape, or form in that kind of business. I just don't think that was right. But again, not in Cincinnati.
It was interesting, kind of in the same breath in that article, they said the Port of Cincinnati, which I guess is different from this local organization, plans to basically rent to own the apartments or homes. So that's going in the right direction for sure. But if they're trying to keep them and rent them, control that, I don't know.
But you look at
That's
the business end of that, like, are they making a profit as the government? And probably not. And are they losing money? And so then are they going to now charge all of the constituents, all the citizens that most of them don't own homes, taxes to fund this program?
Can the government be efficient? That's the thing. Are we talking about a government organization and all of a sudden is so good at running like residential real estate business?
Probably not. As we know, property management is hard. Even if you're hiring a property management company, you kind of have to manage them or at least keep tabs on them. Sometimes got to fire them and go to the next. And depending on where that property management company is in their business, for them to make money, they've got to have a certain amount. Like there's kind of a sweet spot. I forget how many units it is where you kind of have economies of scale and can be efficient without getting too big and then not being able to really service your clients well.
So Alina, you'd probably like to see more of a model like James doing his thing and the government just giving them tax breaks, like opportunity zones.
Yes, absolutely. I believe that's what the government role is, to identify where the need is in the market and essentially incentivize it and stay out of it. I believe there probably was, somebody wanted to look good on the ballot and say, hey, this is what I did. And it does look good for, a low-income families that struggle and say, hey, this is what we did for you, as more of a marketing ploy rather than, something that is going to be really putting in an impact, because it is not a scalable model. You can governments don't have that much available capital, especially local governments, because they don't print money, right? Federal government, that's a different story. But local government's job is really like see where the needs are and incentivize it rather than going in and then just take over whatever. That's now we're going back, government's getting into the business of things, that we're going into a social model, the country like Soviet Union. That's where I grew up. That was one large corporation and everybody was working for it, and that's how it was, and wasn't very effective or efficient in a way. So yeah, that's kind of my take on that.
Is there any way that we can get Antonio to turn on the NSA cone of silence? I'm not sure. Really at its bottom line, at its the basis level, every action has consequences. Sometimes intended, but many times not. Taking units out of a regular rental inventory roll is going to have consequences for the other units around it. Instituting rent control in Portland, Oregon is going to have consequences to landlords, and it's going to have consequences to property prices. And you just can't ignore those. Now, the question is, can we learn to live with them? Yeah, but we have to be pretty delicate and make sure as an investor, you're responsible for yourself. And that's what this is really all about, is learn how to read the room. And there's a great book that I read once called The Clipper Ship Strategy by Richard Marbury. And it tells the story of the clipper ships in America, which, interestingly enough, was only like a 2-year period of our history. But so much income was made during that 2 years. And the premise of the book is you're in your own clipper ship era. Go find the cones of investment. Go find where the government is investing. Go find the incentivizations that are in the tax code for you, and then invest with your ability in that way. And you're not going to go wrong. Just treat it like a marathon and not a sprint.
Yep. Let's jump into the next article. Title is An Ohio Real Estate Investor Who Boasted About His Home Flipping Portfolio on TikTok is projecting a $30,000 loss on one deal, and issued a somber warning to anyone trying to best the housing market right now. And as an example, I guess he purchased a house last year for $248,000. Says he put between $5,000 and $10,000 worth of work into it, which is, did he put in 5 or did he put in 10? That's one's double. Thought that was funny that it wasn't exact. You'd think he'd have those exact numbers, but anyway, now he's receiving offers for $260,000, which after closing costs and agent fees will likely put him in the red. What are you guys seeing? I know I'm seeing a lot of the same.
Well, I think, first of all, in real estate, you make money on the purchase. And this is where, he did not make money when he purchased it. And that's how he ended up in this situation. Plus, once you have, 5 or 10,000 in rehab, you should be done in maybe a week, right? It's not that much. Obviously, there wasn't a major rehab. And if it's such a great area, you should be able to go for sale by owner and just find a buyer yourself and then save yourself $30,000. I don't know commission fee, if that's, or get your own license for that matter, pay 2.5 to the buyer side. I mean, there's always the ways, right? As a seasoned investor, you find a way to reduce your costs to make money, again, in any market, at any time, under any circumstances. So the fact that like he's issuing a warning, I mean, yeah, all right, just find better deals and then do your numbers better. That's all I'm gonna say, right?
Mm-hmm. Well, I run a local creative financing group, and there's a lot of wholesalers, fix and flippers, and each month at our in-person meetup, we meet up at somebody's flip, either at the very beginning, sometimes in the middle, sometimes at the end, and we usually get out a whiteboard and have the flipper basically, write out all of their numbers. Here's where they got the deal, how much they paid for it, how much the wholesaler made, what their hard money costs are, what they assume their fix-up costs were, which is the big what if, and their after repair value, their ARV. The smart ones back off of what that ARV is. But like this guy, he mentioned in the article, he's like, I'm backing off like 10% on both ends of that, just in case, because he's seen it flatten. And the last couple of meetings we've had a lot of flippers get into trouble. Either are sitting there waiting for offers, hoping, and because they got their numbers wrong and went too high. So that's a very common theme. And as an agent, I'm talking to a lot of other agents. Everybody's overpriced and they're having to reduce prices, which obviously, that puts a red mark on that property when you're reducing prices, and then it's like they're going to get chewed up. So
Yeah.
One person's failed flip is another person's blood on the water.
Yeah. Oh yeah, the sharks are circling.
Totally. And Alina and James, you both alluded to this. He didn't know his numbers. So first of all, how did he know how much of a loss he had if he didn't know if he spent $5,000 or $10,000 on the property? But I think that generally shows a lack of detail orientedness that's necessary in these things, not just to understand. He probably didn't calculate correctly on the pricing and then on the fix-ups, and then obviously not calculating the most important part, which is the market. One of the things that I would say that I think a lot more now of, in a market where we don't know exactly how much price reduction we're going to experience yet, we might have predictions. If you're in the business of wanting to make money buying and selling property, I would encourage people to consider wholetailing if they're going to close on it, or wholesaling even more ideally. Like, get in and out of the property in the market you're buying it in, and instead of buying it and now you're selling 90 days later where you don't know where you're going to be at, or back out so much of a percentage. I think 10% is kind of, it's just an underestimate of what could happen. Yeah. I mean, 30 to 50% is probably more realistic if you really want to be safe, if you're going to flip. But the encouragement is wholesale or wholesale being, ideal. Get in and out of that deal so you can make sure you make money.
100%, Matt. Although I will say the wholesaling itself sometimes tends to add another cog into the wheel, whereas you guys are actually out there as real estate professionals, are going to be able to gauge cost and represent that and make your side of it adequately without having to gouge. The problem I've seen with wholesalers is that so much they start, their beginning number is what they want to make. And so then what they offer the person for the contract reflects that. And then what they try to sell it for on the back end reflects that. And everything's built off a profit number. And that's what you can't do. That's probably what this guy did, is he went and said, I want to make this much, so I think I can do that. But back to the very beginning of our conversation about education, TikTok is the absolute best place to get education on real estate investing. Said no one ever. Don't feel bad for the guy, though. I guarantee you he made more than enough on his TikTok to make up the loss.
Yes, that's what I thought too. He sounds more like a showman rather than an investor. He's more of a showman doing investing rather than investor doing the shows.
Right, very true. I wonder how much he can make off TikTok. Sometimes I hear, like YouTube, how much people can make off their channels. I'm like, what? Some wealthy people that have made money doing that. So
It's feast or famine now. The algorithms are absolutely rewarding those that are already getting views and absolutely not given much love. I mean, the inequality of attention is probably growing more rapidly than the inequality of wealth on the social media.
That's a good point. Wow.
are any of you guys on TikTok posting any content?
No.
Not of any significant amount. Being a person who works with investors and agents, my thought process, probably very wrong on this, is we're more likely to find people on places like YouTube than, I don't know that our ideal client avatar is hanging out on TikTok.
That's right. It's a younger generation that don't have an income yet. And if they're going to continue watching TikToks, they probably won't have anyone either.
Interestingly enough, though, there is a huge phenomenon out there where in the short-term rental market nationwide, there's a huge movement to bring in influencers for extended rent-free periods in exchange for a promotion. So, I mean, you can't ignore it as an advertising strategy. Just you kind of feel like you need to wash your hands after it's over.
Right. Dave, I love that. I really, really love that thought, because essentially on these platforms, it takes a lot of time and effort and money pouring in the resources to develop the content that's contextual to the platform and to get that traction. And so I think you're absolutely right. If you're going to dive into that platform, just go straight to who has the attention. And yeah, I think that's really, really awesome.
That's smart.
I also love to see like how all the articles had the titles has a doom and gloom in them. If you kind of read through the common theme, it seems like they're really portraying this, horror, terror, and if you read in a little bit deeper into each one, every time ends up to be not really that bad. But I guess bad news sells, and that's where we, always going in. That's why we're having those discussions, right? Talking through this, and not just reading headlines. Because if you read headlines, you will never ever invest in anything. It just because when you in fear and you in doubt, you will never make a good investment. In anything, that's not just the real estate, anything. If you're trying to invest out of fear of missing out on the deal, you will overpay and lose. And if you are trying to, invest and you're fearful of the deal, you will have so-called opportunity costs, meaning you didn't invest and you sat on it and it passed you by. So there's costs either way, right? Either overpaying or the opportunity cost of investing. And that's where, probably reading the news is not exactly the best way to invest. I think reading the numbers, looking at your own numbers and doing your own data analytics and not reading headlines is probably better strategy for your mindset. That's where good investors should always be. Local markets, hyper local, knowing your market, having some boots on the ground, and really reading your local analytics, whatever that is. We actually do it for Chicago, in northern Illinois markets. We run our own analytics and we provide it to our client base. Like we have infographics that we generated for consumers and real estate agents. We also have a marketing platform that use our own analytics. And I love looking at our own data just to see how the map lights up with green or red, how the markets are moving. And we're still in such a seller's market. I mean, historical seller's market right now, even after the rates has increased. And again, it's a Midwest. We're fairly stable. We haven't had the spikes, ups and downs. But if you talk to, if you read the news, it seems like we're literally in 2008 right now. So yeah, that's kind of my overall impression of the market at this point.
Yeah. And this right here is why this show is so important. We can read these crazy headlines and then dissect it and bring some levity and reality back to our viewers and learn from each other. Just hearing
100%.
Yeah.
And Alina, you built funnels. So, like I had a period of time when I was writing some sales copy, like I want to be the person who espouses all of the positivity. And then you just watch your clicks drop like crazy. And, it's people's fear of loss is so much more important to them than their desire for gain or anything like that. And it's just like, well, now I have this conundrum. Do I market to people in a way that they'll actually click it so I can get them the information that they need, or do I not? And of course, I think most people come to the point, well, it's better to connect with people than to not. But it's pretty sad, unfortunately, that if you really want to reach people, you got to go straight for all these. Yeah.
It's literally, it's a template, how to avoid problem without, objection and to get a solution. It's like a template of your any headline.
Yeah.
Yeah.
Totally.
Well, hey, let's jump into the next one. It's similar to some other stuff we talked about. Interest rates, layoffs, and workers choosing home are causing office building values to plummet. And so they threw out some stats like there's a record high 27.1 million square feet of office space available. See, the value of office buildings could see a drop of 39% in the next few years, according to professors at Columbia and New York universities. And they're seeing a lot of tenants not renewing their leases, going either fully remote or renewing their leases, but signing up for less space. And then they also mentioned tech layoffs, like those at Twitter, fueling significant empty offices. So, and then
speaking of potentially bad news,
right. Any comments on that stuff? We could just jump into the next news item.
I hear an opportunity.
Mm-hmm.
As an investor, that's like, it sounds like we all need to look into office to residential conversions.
Yeah.
Yep.
I think the only thing that's tough about that is that people are losing jobs. Like I think the office space getting converted is just an opportunity for investors to reposition their assets, or if they don't want to reposition them, they can sell them hopefully sooner than later. But the sad part is people losing their jobs. And so hopefully they undergo the same type of transformation that these assets are, which is, hey, the market is moving. We're moving in a direction of globalization, technology. Maybe I can build some new skills and reposition myself to be in a better spot.
Something on the labor market. This is actually not from me. I'm literally reading off the post that Lawrence Yang, the chief economist of National Association of Realtors, just posted yesterday on LinkedIn. And he basically said that we have a bizarre labor market currently with nearly twice as many jobs opening as there are unemployed people searching for jobs. Essentially, what it tells me, it's not that the lack of jobs, it's a lack of ability in people to adapt and start getting into the new jobs that are available. It doesn't sound like I still have a lot of business owner friends that are struggling to hire right people and struggling to hire people. So I don't really think we're in the same type of labor shortage. Like we're not in the same situation like 2008. We do have jobs. It's that just some jobs in certain sectors, right? We have sector rotations. Technology been peaking out for like so long. Now it's kind of on the downward cycle. Therefore, you're going to have some people from tech moving into other places, and hopefully they're flexible enough to do that. Just like us, real estate investors, we constantly have to change and shift what we're doing. So eventually people will realize if government does not put in too much into supporting the people's behavior of inaction, then we will see people learning to adapt. If we have a lot of government involvement into like literally incentivizing looking for what you want in the marketplace as a job that you're only going to do, and else you're just going to get a unemployment paycheck, then we will have an ongoing crisis in this country in general, because there will be immigrants, there will be other countries. We're in the global economy where you can hire anybody from any country and they are competing with you here in American soil. And if people in America will not get that message because government is incentivizing it by the stimulus checks, then we as a country will become weaker. I had to get this out of me.
I love what you said about sector rotation, because now this is not 2008, but if you want a great comparison, this is 2000, the last great tech bubble, when companies like Webvan, Palm, a lot of the grocery delivery services, everybody started to develop the same technology platforms to do the same things. And there was a bloodbath. But you know what happened to real estate during that time? It just marginaled out. It stayed fairly flat. And where did some of those displaced workers go? They became real estate investors. And interestingly enough, they did the same thing that we're starting to see today. I have more clients than ever. I've got several acquaintances and friends of mine that are in business brokerages. And what these people are doing are taking their buyout packages or the money that they've saved, and they are buying businesses. Sometimes they're businesses that have a real estate component, like a restaurant or a liquor store, or sometimes, though, they're simply businesses. My friend was telling me last week, he sold a lawn care business to a California tech guy who wanted to live in Florida and have something to do. People will find a way, and you're absolutely right, Alina. As long as the federal government does not subsidize unemployment, we'll see a slow shift back. But that's what happened, wasn't it? 2019 to now, we incentivize people to stay home. First out of fear over COVID, then out of fear of creating this weird dichotomy in the labor market. Now it's whatever. But we created fear and then paid people to stay home. Bad move. Let's pay people to go to work and to start HVAC companies and painting businesses and accounting firms. That's where the future of America has always been throughout its history.
Yep. Let's take a quick ad break and we'll get back into it. So one of the best ways to increase your company's brand awareness and increase warm leads is to create written content online. But as we know, content creation can sometimes be a slog. Content creation can be very time consuming and not very cost effective when having to pay professional copywriting fees. It's time to stop spending countless hours writing and paying exorbitant copywriting fees. It's time to use REI Content Packs. REI Content Packs, done for you content packs, give you the tools, flexibility, and cost-effective ways to increase your brand's visibility and online presence without spending hours or even days stressing on what to create. REI Content Packs are a collection of high-quality, ready-made real estate blog articles exclusively created for the real estate investing industry. Can you imagine the possibilities? If you could do 2 to 3 more deals per month without increasing your ad spend, REI Content Packs can help you do that. Can you imagine getting unlimited online traffic, increasing your Google ranking, getting more leads, and making more money? REI Content Packs can help you do that too. To get started increasing your brand's content and lessening your workload, head on over to thismonthinrealestateinvesting.com/REI Content Packs. That's thismonthinrealestateinvesting.com/REI Content Packs, and tell them you heard it on This Month in Real Estate Investing. It's time to get off the online marketing hamster wheel. Try REI Content Packs today at thismonthinrealestateinvesting.com/REI Content Packs. All right, let's jump into the next article. And by the way, I know who's behind REI Content Packs. Very trusted source. I'm behind what that is and who's behind it. So check it out. All right, let's see. Our next one is one of the top ones I had called out earlier. Mom and pop real estate investors are pulling way back. Here's where and why it matters. So for the past several years, as those of us in real estate investing know, and consumers are aware of, there's venture-backed capital, venture capital-backed investment behemoths and mom and pop newbies alike pouring money into real estate and making it a very competitive situation with mortgage interest rates at historically low levels and stimulus cash, like Dave was saying, sloshing around the economy. Investments went just crazy. It was feverish, as they put it in the article. And along the way, investors, many who came to the party with all cash offers, fully changed the face of many markets, which locked out a lot of first-time home buyers, which is not necessarily a good thing. But now rates have soared. There's been large hikes in rental prices, but those are beginning to slow. So what are you guys thoughts on that? Like specifically the large hedge funds versus mom and pops, and how's that affecting things? There's a lot there.
Yeah, I think large hedge funds that are in the market honestly is not really producing a lot of good things for the economy. They create, somewhat spikes. I hate to call them bubbles, but they're like, spikes in the local real estate markets. I honestly think it's not a bad thing that, rates went up and then it's kind of stabilized things a little bit in a way. Right, some markets it's probably going to affect more than others. Speaking more on the Midwest, we haven't seen a crazy ups or downs like some other market. It's definitely, I can see how a lot of small retail investors would now back out of the transactions. I believe in today's investing climate, you should be mostly cash. So if you don't really have a cash to invest, maybe partner up with some other investors to, have enough cash to transfer. But avoiding leverage right now would probably be best. And then most of the local small retail investors don't really understand that concept. They don't know, how to do this, right? They don't know how to do syndications. So maybe that's probably why you can see a lot of those investors backing out when it's really should be the time to start looking for more deals rather than backing out of the market. Because an easy way to do it is gone. Doesn't mean you should be completely out of it. But again, that means there's not enough as sophisticated or in more educated investors that are on retail level that understand how you still can continue to be in the market. That's I am hearing from this news.
Yeah. Yeah, another thing they mentioned in the article is kind of a shift from, markets on the coasts where, it's always been higher purchase prices and harder to make cash flow and stuff. But the way things have moved, it's driving them more inland.
It's overbought. I mean, some of the markets, I know California a long time being like a ground of, Chinese investors are purchasing without even looking at the properties. I mean, it is insane how some of those markets just bubbled up to unrealistic, insane prices that just beyond it. We're not even talking moms and pop shops can't even invest there. It's just they're all competing with, individual cash investors from like China.
Yeah. Oh yeah, that's a huge
Vancouver
thing.
was a tough place for a long time because of that. What's interesting though is it's easy to throw stones at the big institutional investors, but those very same investors are going public and offering part of their profit in stock shares. They're the same kind of platforms that are creating fractional ownership opportunities.
Mhm.
So in some models, they're actually creating some of the wealth opportunities for people who can't start on their own. And that just occurred to me, but it's like there's a place for them. So
Yeah.
what's the problem? Why are we kind of feeling angsty about this? I think it's more because it's an education gap that mom and pop, whoever that is, doesn't understand. And what they don't understand is that there is more ways to invest in real estate at the entry level and at the small level than you could ever imagine. You don't have to have deep cash pockets. You can do what we talked about earlier. Go buy a primary residence to live in and start it out that way. We have so many clients that will start out as what we call accidental investors. We're getting married later in life. So he's got a house, she's got a house. They get married, they move into one of them. Well, the other one just became a rental property, didn't it? And that's their start in real estate investing. Matt, you talked about house hacking. I mean, that's a 2020 phrase that everybody should know. Because all it means is you're buying your house, but you're getting paid for other people to live in it with you, whether it's a duplex or it's a room. We've done that accidentally for 27 out of the 34 years we've been married. We never even thought about it. But it was like every time an opportunity came along, it's like, well, yeah, we'll rent you a room while you pay off student loans. Sure, we'll let you live in the apartment in the back. Sure, we'll treat part of our property as an Airbnb because it's close to the beach. All those kinds of things are available to mom and pop, but they get paralysis by analysis, no, not by analysis even. They get paralyzed because they only see one way that's going to work. There's so many ways that can actually work.
Yeah. That's the double-edged sword of real estate. There's a lot of opportunities, and you can get bogged down by like trying to figure out which direction to go to. But the fact that there's all these different opportunities is amazing. And you're talking about house hacking. The I don't know if you guys use the same term I use, nomad investing, where you buy your primary residence, you keep that as a rental, and move on, buy another place, and you're getting the low down payment, low interest rates because it's a primary. And if you just keep doing that, you're going to be a wealthy person. You don't even have to go out and do anything else besides that. It helps to start when you're young, and it's not a big deal for you to have roommates and move every couple of years. But I always tell young people, like, if you got a W-2 job, go do that. Everything else will be gravy. So,
Did you go travel?
oh, what's that?
Did you go travel
No.
with your nomad investing?
Oh,
Did you travel?
doing that, buying one after the other.
Yeah.
No, gosh, I wish I would have. I probably wouldn't be sitting here.
We lived on a sailboat for 10 years.
Oh,
And we used our rental income from short-term rentals and from our primary residence being rented to fund we raised 4 boys on a sailboat.
wow.
Yeah, it can be done.
Yeah.
That's so awesome.
And does the school bus comes to the sailboat?
If you haven't gathered yet by now, I'm kind of more of a free range kind of guy.
Mhm.
So the NEA was not involved in our education.
There you go.
How
But
long
I've
did
got
you
an
do that?
electrical engineer and an economist to show for it. So I think we did something right.
Nice. How long did you do that, Dave?
Well, we started this whole goal in 1996 in Denver, Colorado. My wife was from Minnesota. I was from Kansas. We met in Colorado and decided to live on a sailboat. What the heck? But 10 years later, we had positioned our portfolio using 1031s from Colorado to Connecticut to Florida, selling primary residences as we went to fund the boat purchase. And then 2006, we moved onto the boat, lived on it for 10 years while we raised our boys. The boat was paid for with tax-free dollars, and the deferred tax from the 1031 funded living as we went.
That's amazing.
Awesome strategy.
It doesn't take that much. You can do it. What most people don't realize, and we were going to get to this somewhere at some point here, is what mom and pop doesn't realize is not only there are different ways to get into real estate, but you've got to understand the ways you make money. It's not just appreciation. People in California think, oh, I'm done. I can't invest because it's not going to appreciate anymore. Well, there's also cash flow, isn't there? The people in Omaha are saying, okay, I'm making a couple $100 a month, but it's never going to appreciate. What can I do? There's also, though, 2 other ways we make money. We make money off of the depreciation, which is the tax benefit that you get that offsets any income that you have coming in. That's a real financial benefit to you. And then the other money that almost nobody remembers is the amortization of the loan. Yes, interest rates may be high, but guess what? That interest rate is also a deductible expense.
Yep.
And any principal that is being repaid is being repaid by your tenant. That's free money to you every year. Now, those 4 calculations are all found in what's called the internal rate of return. And if you're just starting out, you got to learn those, because that's what's going to open up the door so that you can invest in real estate and be just as successful as any of those big yonkers.
Yep. Let's unless anybody has other comments, let's jump into the next article. Guess I got to pick one here. Let's talk about this one. The company is forced to give 90% of their profits to investors each year. So they're talking about Warren Buffett's company. You know, he's been traditionally against real estate stocks and mainly buying companies is what he does. But so they ended up buying Store Capital, which is a REIT, a real estate investing trust. And Store Capital, it cost them $377 million to buy it, and Store Capital controls over 3,000 properties across the U.S., including restaurant sites, manufacturing facilities, preschools, auto repair shops, and gyms. It says. So it's, you know, I'll be interested to see what you guys know about REITs, if you've invested in them. So let's kind of leap off with that.
Well, I mean, I have high faith in Warren Buffett's evaluation of companies.
Yeah.
And so I would imagine, like a lot of things, if you don't know what to do personally, a lot of times you can emulate people that have proven track records. Now, I mean, obviously they might be investing for different reasons, but my understanding in reading that article was, you know, the Regulation A benefits. There's a lot of benefits that they get as a result of giving away 90% of their profits. And it sounds like that's what he was most excited about, in addition to the direction of the company is, you know, he's investing in a company that's giving back profits to consumers, but they also have some pretty amazing benefits given that they can file with Regulation A.
Yeah, they talk about, let's see, being exempt from corporate taxes on the holdings. Yeah, big advantage.
Yeah, the SEC requirement is the REITs return X percentage of their profit
90.
back.
Yep.
90% to the investors every year. That makes REITs an incredibly attractive investment during certain parts of the market cycle. But again, it's all part of reading the room and knowing where you're at in the cycle. When everybody's making money hand over fist, who else is? The REITs are going to be, and that's going to make your returns higher. So you'll see them fluctuate quite a lot during the cycle. The fact that they have to return 90% means that A, they want to keep their internal returns to management, to the managing company, high, which means they have to generate more and more and more revenue as you go through a cycle at a time when they are also paying more and more and more for real estate assets. So it's usually what we see later in market cycles is that REITs will have a reducing rate of return to the investors. Now, that's not wrong or bad or good or right or wrong. It's just what it is. But if you are investing in a REIT late in an investing cycle, hoping to gather the kinds of returns that it had 2 years ago, you're probably going to be disappointed. So what's curious to me is why Buffett is making this move right now in what a lot of people think is the latter stages of a real estate market cycle, which should be followed by a crash. Now, it could be he's just preempting that. And by crash, I don't mean 2008, I mean a retreat. It could be, and I think probably, that he's anticipating that retreat. He priced it into his offer to them. And now he's just sitting there waiting. And he's going to own a massive REIT at the beginning of the next cycle that's going to be generating tons and tons of money for investors. I think that's probably what's happening. But I think REITs are a great way to get in and out. Now, you don't ever get the tax deferral of a 1031 exchange because you don't actually own real estate. But there is a lot of transparency because of the SEC rules that they can be a great way for you to invest with little and start an education in how real estate ownership can work for you.
You bring up some good points, Dave. I mean, given where the market might be heading, these hedge funds or whoever's running these REITs might be a little bit scared of the outlay of cash or some of the problems they might have. And so maybe they're selling at a pre-discount to Warren when, you know, so he understands there's going to be some turmoil, but he's getting it at, you know, he's getting it at a wholesaler price, so to speak.
Yeah, exactly.
Overall, with the market volatility as it is right now in the equities market, it's wise to be in more stable asset. And as you remember, Warren Buffett rule, never lose money. Where do you put money that it's still not going to be, exposed to inflation as much as, let's say, maybe bonds that are just producing, fixed percentage. I think REITs that just probably in the next, year or two, just more stable, less volatility, asset than anything else there is in comparison. So you can't be sitting with just US dollars, because we know that's not good. You cannot be too much in equities because those are volatile. The bonds are not exactly, might not be even beating inflation. So perhaps REITs are the, one of the few asset classes that are, other than going and hassling yourself and buying enormous amounts of real estate directly, and managing all of that, is probably the only one where you can, put in a very large sums of money and have still liquidity, more or less liquidity.
Yeah, what was his other mantra, Matt? That feeds right into what you said. When everybody is greedy, you should be fearful. When everybody's fearful, you should be greedy. I guarantee you, if I'm a REIT manager and I'm looking at a potential 20 to 25% reduction in the net worth of my portfolio, I'm starting to get a little fearful. And that might be where he's starting to get a little greedy.
Mm-hmm.
Totally.
I love following him. All right. Hey guys, we have one bonus article. So avoid these 10 cringe-worthy phrases that are annoying your coworkers.
Hello, BuzzFeed.
You might think you sound more professional using corporate lingo, but chances are you're probably annoying or confusing your coworkers. In a poll of 4,500 people, here are the top 10 most annoying corporate buzzwords. Synergy, out of the box, take ownership, value added, circle back, reach out, going forward, proactive, takeaway, and make it happen. These jargony phrases are particularly off-putting because they're vague and can often come across as passive-aggressive, says David Wojcik, career and executive coach. So, yeah, I feel that.
All right, we'll add one to that.
Yeah.
What do you got, James? Bring one to us.
Oh, an extra one? Oh, putting me on the spot. I don't know. You have one?
How about I'll take that under advisement?
You'll have to come in on Saturday.
There it is.
Yeah.
Well, okay, but I have to come in here with like my NLP, neuro-linguistic programming background. It's something that came to my mind as you were reading. There is a phrase that words actually have certain energy. They create certain energy, and they also can disperse that energy. So the words, like if you don't like when somebody's saying something in a meeting, or you just don't really agree with the person, but you just don't want to, confront them, you can use the phrase, "It's neither here nor there." That is actually disperse the energy. So whatever energy or charge that the other person's words have came into, you can use this, "It's neither here nor there," as to disperse the energy of the conversation that came into you. And words are just, again, energy. Energy can create some emotion.
Yeah, I think people using their words should consider like some real estate flipper strategies. So the strategies that we love to use in our flips is using classic timeless styles that are going to hopefully last and be really nice for our people who buy our properties for a long time, as opposed to what's trending. And so I think if people just are authentic to who they are and use words they would normally use, then they're not going to have issues.
Yep. Yeah, we should put together our own list for real estate, because those are very corporate-y, but
very
game changer.
Maybe years since I've been in corporate America, I know it's its own animal.
How about priced too high? What are some other favorites? Really bad bedroom color.
Right. This one will sell fast.
Oh my gosh.
Get it now.
Undervalue rents, under market rents. That's my favorite of all time.
Yeah.
Under market rents, which makes it a bargain. I'm still trying to figure that out.
In rent control areas.
Just raise rents.
Right. Exactly.
How about cozy home?
Cozy. Yeah, that's for the doghouse in the back of the house, right?
That's funny.
Okay, hey, I got to jump in here with a special announcement. The end of the year is here, and a lot of things have happened in the real estate investing industry. So join United States real estate investor founder Antonio Holman, our producer and mastermind behind this show, and his guests on December 28th for at Year's End Recap Summit live stream. Stay tuned and subscribe at UnitedStatesRealEstateInvestor.com for details. Guys, I'd like to thank our awesome guests. You guys are what brings this all together and makes it so valuable. I love it. So thank you, Alina, Dave, Matt. I'd also like to, again, thank Antonio for putting this together. This was his brainchild, if that's even a thing. And also like to thank our sponsors, Jason Palliser's 2-day blueprint and REI Content Packs. To subscribe, follow, and stay in touch with This Month in Real Estate Investing, visit thismonthinrealestateinvesting.com or find the show on your favorite podcast app. It's on all of them. And thanks for watching. And as always, know when one door closes, another door opens to more financial freedom. Thank you, everybody. You've been awesome.
Thanks.
If you're listening to this, there's a good chance you work within the real estate investing industry. There's another good chance that you would like to increase the sales of your products or services. Well, you're in the right place. United States Real Estate Investor is a platform you need to place your brand directly in front of your target audience. With our focused, growing audience of real estate investing beginners, enthusiasts, and seasoned professionals, you can continually reach our captivated viewers and listeners with ease. To learn more or to get started today, just visit UnitedStatesRealEstateInvestor.com/advertising. That's UnitedStatesRealEstateInvestor.com/advertising. Get ready to increase your brand awareness and your bottom line. Attract clients with content.